Hey guys, welcome back to Teen Stock Money, and today we are going to be describing what a stock is. The term is often thrown around, but most people don't have a full understanding on what it is, and today we want to change that. We have timestamps down below, so feel free to jump around, and anyways, let's get right into it. Before we get into what exactly stocks are, we thought it would be a good idea to go over brokerages and other places to trade stocks. A brokerage or broker is kind of like a middleman. They are a firm or a person who arranges a transaction between a buyer and a seller. More specifically, however, they are the buyer's representative. The buyer is able to tell their brokerage which stock, bond, crypto, or option they want and when they want it, and the brokerage just tells them the price they would have to pay. Then, if the buyer agrees, they pay the brokerage and the brokerage then buys the virtual asset for them. Now you may ask, what are some brokerages and what are the benefits to each of them? Well, I'm going to go over 3 for you guys in this video. So the first one we'll talk about is Robinhood. So Robinhood is the platform which I personally use to trade stocks, crypto, and options. The pros to Robinhood include they require no account minimum, they have a really good streamlined interface, meaning it's very simple but gets the job done. They permit cryptocurrency trading, they allow fractional shares purchasing, and of course they have 0% commission fees. However, the cons to Robinhood include that it doesn't have any retirement accounts, it has no mutual funds or bonds, and the customer support isn't the best. Robinhood is best for individual taxable accounts or also margin accounts. The next one we will be talking about is Webull. Some pros include free trading, an easy to use platform like Robinhood, advanced tools, and access to crypto. However, also like Robinhood, it doesn't have any mutual fund and Webull also has thin educational support. I would say Webull is best for intermediate level traders who actively trade stocks, crypto, or options. Finally, the third and last brokerage I'll be talking about is the popular TD Ameritrade. Some pros to this top-rated brokerage include commission-free trading, free researching, no account minimum, good customer support, and a large investment selection. The only major downside to this platform is that they don't allow fractional shares. Overall, TD Ameritrade is best for both beginner and advanced level traders, education and advice, and fund investors. All these brokerages mentioned are very good, but I highly suggest that you go more into depth on each of them before making your decision. Anyways, let's get into the definition of stocks.
Think of a stock as a slice of the pie, where the company is the pie and the shareholder's share is a slice. When you own a share, you technically own a part of the company, although most of the times it isn't enough to have significant power over the company's decisions. Common stock, the type of stock we're talking about today, is traded most commonly on stock exchanges. Now that we have a basic understanding of what a stock is, let's talk about how it moves and what causes its prices to fluctuate. As we mentioned before, stocks are traded on a free range market,
meaning that prices are dependent on supply and demand. High demand for a stock causes a stock to rally. When people are selling, they add to the supply, while reducing demand as well, and that causes the stock price to plummet.
This push and pull between supply and demand are what causes stocks to move. But then we must ask the question, what causes this buying and selling of stocks? To most people unaware about the stock market, including myself before I learned about it, it seemed as if prices move at random, without any actual reason behind them.
That is why most people view it as a gamble, because they don't understand what causes movements.
However, that is far from the case. While it is true that it is impossible to predict the future price of a stock, investors can use several financial models and tools to accurately estimate the future price of a stock. Factors involved in the calculation are
earnings per share, or how much the company has made in terms of a per share basis, revenue growth year over year, and even less quantitative factors such as the credibility and trustworthiness of people in charge, such as CEOs or management.
Again, nobody sets stock prices. They're actually determined by the market sentiment towards that particular stock. So in a way, the stock market itself is a kind of forecast where people are trying to make money by investing in something in the future while still in the present. However, don't be fooled. Every investment is like that. It's just that some investments are more volatile or risky than others.
But risk and reward are proportional. So the riskier an asset seems, the more potential it has for a high reward.
And there you have it. That is an extremely oversimplified introductory understanding of the stock market. There are a lot more layers to the market than I have just explained. And while Teen Stock Money does hope to make videos on this in the future, we still recommend that you do individual research if you're interested to gain more knowledge about this stock market. Further explain the stock market, let's take the analogy of a bakery.
Let's say you started a bakery and were selling all kinds of baked goods. You invested your savings into buying a venue and stocking the store.
Luckily for you, everything turned out well.
Your one location is racking in profit, and the outlook of your business seems promising.
You want to build a baking empire fast so the competition can't eat into your market. But there's just one problem. You don't have the money to do so.
Although you have the profit from your one location, it covers your expenses and doesn't leave much to buy a new venue.
Lucky for you, word is spread around town about your bakery, and people are interested. Wealthy people.
They want in on your business, and in return they can provide you with the funding you need to grow your baking empire. You agree and give them a certificate saying that they own a part of your company, and in return they pay you a sum of cash to buy multiple locations around the city.
Your profits rise, and you only grow, attracting more interest.
Some of your original investors find it the right time to sell their share in your company to someone for a higher price, cashing in more of their profits.
This cycle continues over and over again. I hope this cleared up some confusion from the prior segment, and if it didn't, feel free to check out the links in the description to websites which have more information about this stuff.
Now that you understand what a stock is, let's quickly talk about some major stock exchanges. A stock exchange is a marketplace where stock brokers, traders, buyers, and sellers can trade in equities products. The largest exchanges have thousands of listed companies. These companies sell shares of their business, giving, as you already know, the general public the opportunity to invest in them. Anyways, almost every large nation in the world has at least one stock exchange. For example, the largest and the second largest stock exchanges in the world are both in the USA, headquartered in New York City. They are the New York Stock Exchange and NASDAQ. The New York Stock Exchange has an equity market capitalization of just over 25.6 trillion US dollars, and NASDAQ trails behind with a market cap of just above $19.5 trillion as of Feb 2021. These two stock exchanges completely demolished their competition in terms of market cap, at the number 3rd spot, Hong Kong Stock Exchange, is under 7 trillion. Now let's talk about the importance of stocks in today's world. Most people think of the stock market when they hear the word economy, and for good reason too. One of the biggest benefits of the stock market is that it allows common folk like us to take advantage of economic growth. Oftentimes at a job, people get raises that don't stay ahead of inflation. Inflation is essentially when, due to more of the currency being floated, the value of each dollar goes down. Therefore, the holder's purchasing power goes down as well. If you put the dots together in our workplace example, where you're getting a raise that is less than inflation or no raise at all, then you are effectively making less year to year. However, the stock market historically has averaged a 10% annualized return, and the Federal Reserve, the private institution responsible for inflation control, does its best to keep inflation under 2% annually. Furthermore, as our economy grows, corporate earnings do as well, since economic growth means more jobs. More jobs means more income, and more income means more buying power per household, which means more sales for companies. Nowadays, with online brokerages making it so easy to buy and sell securities, the only thing today's investors have to do is research potential stocks to invest in, and of course, be able to handle the emotional roller coaster of the stock market. Overall, that pretty much wraps up today's video. Hopefully you guys got a good understanding on what a stock is, its role in the economy, and why you should be investing in them. As always, thank you so much for watching, and see you guys next time.